Hey traders, Jason here from Leavitt Brothers. The market continues to do absolutely nothing. It moves up, gives hope to the bulls, the indicators improve some, and then it reverses. Then it moves down, the bears get excited, the indicators roll over, and it's back to the beginning. I posted this chart on Twitter last week as kind of a joke, although I was actually very serious. It's the S&P 500 with everything between December 1st and today blocked out. You can see that since December 1st, the market hasn't done much of anything. Every so often, you need to eliminate all the short-term noise and remind yourself what the net price movement is. Okay, here's another way to look at it. Okay, I've removed the price chart but added a 50 and 200-day moving average. This vantage point will allow you to somewhat ignore some of the short-term noise and give you a glimpse of the trend. Okay, in this case, with the 50 being flat, we can conclude the short to intermediate term is neutral with no obvious trend, and the 200 reminds us that the long-term trend is still up. Okay, let's flip through a few charts and see what hints there are beneath the surface. Okay, here's the NASDAQ advanced decline line and the NYSE advanced decline line. Both overall are trending up. Both are above the 200-day moving averages. The NASDAQ version looks a little flatter and more neutral. The NYSE version has only flattened out over the last couple months. But overall, the picture is still pretty good. Okay, if the market was really in trouble, if there was trouble brewing beneath the surface, both of these lines would be moving down. Okay, if you look at major tops we've had over the last 15 years, actually you got to go back like 20 years to get the dot-com bubble top. These types of curves would be trending down for a couple months before a major top was put in place. Right now, they're just simply neutral. I consider it a consolidation pattern within an uptrend. It's kind of frustrating. If you want, an uptrend to place, you can be long stocks, aggressively long stocks. But right now, I consider this to be a consolidation pattern within an uptrend, and I don't see any major warnings. Okay, here's the S&P 500 up top versus the NYSE advanced decline line. It's the 10-day moving average of the advanced decline line. For those of you who have listened to my videos before, you know that uptrends tend to be characterized by the advanced decline line staying mostly above zero. Okay, so you have like a period here where the market trends up and the AD line's above zero. You have here, same thing. We got a nice uptrend above zero. So what we have now is we have a lower high, we have a couple higher lows, we have some big swings above and below zero, we have no ability whatsoever to stay above zero or to stay below zero. The bulls, the bears, they take control for a few days or a week, and then they relinquish control to the other side. Okay, I consider it neutral. It's a battle going back and forth. Nobody's in control. It doesn't suggest we have strength brewing. It doesn't suggest we have weakness brewing. We just simply have a stalemate. We have a market that's in range, and we have the bulls and the bears are just battling it out equally with nobody really having an advantage. Okay. Next chart. Now we have the S&P 500 up above versus the 10-day moving average of the AD volume line. Okay. The advanced decline line lets all stocks count equally, so it doesn't matter if you're Apple and you're worth 900 billion or you're a small cap company that's only worth 1 billion or a half a billion. They count equally. With the AD volume line, it lets the higher volume stocks do most of the talking. Okay, most of the higher volume stocks are your bigger companies. There are a few small ones, but for the most part, it's your big companies. So sometimes the message is different. In this case, it's not. Okay, we have if I could just draw some quick lines here, we just have lower highs. We have higher lows. Okay, here's the zero line, so we have just oscillations above and below. The bulls take control, the bears take control. We have some swings up and down. Nothing lasts. It's just an equal battle. Okay, if you're short term, if you want to make money right now, this is frustrating because we don't have a trend in place. But if you've been trading for a while and you plan on trading for a while, you just realize that, hey, the market trended up for a long time. We got a really great rally off the early 2016 low, and now the market's in consolidation mode. It's been there for a couple months. It could last long. We don't know how much longer it's going to last, but it's just the way it goes. The market's neutral, And there's no hints here that the bulls or bears are gaining any type of strength. Okay, new highs. Obviously, they've been subdued for 1, 2, 3 months. This is a lagging indicator. If the market attempted to rally, then you'd expect new highs to move up a week or two later. Okay, it doesn't lead. It lags, so it acts as a confirmation indicator. The market moves, then this indicator either confirms the movement or it denies the movement. So right now it's just hanging out. It's just, it's between 20 and 80. There have been a couple moves up, but nothing big. It doesn't tell us anything. We'll get if the market moves up, then this will move up a week or so later. It'll either confirm the move or it won't confirm the move. So right now we don't get anything from this indicator. Here's the high-low differential at the NYSE. Again, for those of you who are familiar with my work, you know that characteristic of an uptrend is when the high-low stays above zero. You can see in the blue box here. Okay, highs obviously are going to consistently beat new lows. It's fine if it oscillates above zero within that range, but as long as it stays above zero, the market tends to be in pretty good shape. But right now, as you can see, we have lower highs, we have higher lows, we have oscillations around zero. New highs lead, new lows lead. We go up and down around zero. Again, the picture is neutral. Okay, I know we want there to be a directional move. It's a lot easier to trade when we have a directional move, but right now we just have an equal battle. Bulls take control, bears take control. Nobody has control overall. Nobody controls it for very long. It's an equal battle, and because of this, we have to adjust our trading style to be in sync with the market. Okay, we can't just use a loose stop because a loose stop is probably going to get hit. We have to be a little quicker to take profits because we're not getting much follow through. Recognize what the market is and make whatever adjustments you need to your trading. Don't take the methods that got grilled into you last year and apply them to today's market because they just won't work. Okay, one of my favorite indicators, this is the S&P 500 down below, and up above is the percentage of S&P 500 stocks above their 20-day moving average. It's very simple. When the market does well, the percentage of stocks above their 20-day tends to be above 50%. Okay, that's not a crazy statement. Obviously, you need more than half the stock. You don't actually need more than half the stocks. It's possible because of the way the S&P trades. You can have the top stocks doing very well. But it just doesn't play out that way. When the market does well, you tend to have 50% or more of the stocks trading above this key moving average. Obviously, we've had these big swings where almost none are above their 50-day moving average. Then we have a pretty high number, and then a low number, and then a high number, and we're just going up and down. Okay, a lot of stocks have flattened out. Their 20-day moving averages have flattened out in the middle of their ranges. So the market moves up, and a bunch of them get above their moving average, then stocks move down and it gets below their moving average. We will know if the market attempts to move up, we will know that a bounce has legs and can turn into a full-blown rally if this indicator gets above zero, not zero, if it gets above 50% and stays there. So far it hasn't been able to do that. Each time it's gotten above 50%, it'll push a little bit further and then it'll come back right back down. Okay, so if I were to drop, if I drew a box here, there's your 50%. Okay, we got above, dip back below, climb back above. Now we're back down to the level. Okay, we need this to get above 50% and stay there. That will confirm and support a rally. Okay, failure to do so, and the market just isn't going to go very far. Okay, next chart, same indicator, except I'm using the 50-day moving average instead of the 20. The magic line here tends to be about 50%, not 50%, 55%. Okay, so again, we're going to want this indicator to get up here and stay there. It's as simple as that. Okay, mathematically, the market can move up with less than 50% of the stocks above their 50-day moving average. It just doesn't tend to play out that way. Okay, the top 10 or 15 stocks control a huge percentage of the S&P 500. So mathematically, it's possible if Apple and Amazon and Facebook moved up that they could single-handedly move the market up. But if Apple's doing well, then that has a ripple effect. Semiconductor companies are probably doing well, packaging companies are doing well, shipping companies are doing well. It's not really possible for Apple, for a lot of these big companies to do well and for it to not to ripple elsewhere, which is why you just need more companies coming along for the ride. Okay, so if the market moves up, this indicator fails to get up above 55 and stay there, the rally is just not going to go anywhere. Okay, here's a similar chart, except I'm using the 200-day moving average instead of the 50. Obviously, we've been trending down this entire year. Same rules apply. I'm not going to kind of keep beating a dead horse here. If the market moves up, we're going to need the percentage of stocks above the 200 to improve. Okay, the S&P is above its 200, not by much. Okay, but if we rally here, you know, if the S&P does this, whoops, wrong one. If the S&P does that, then we're going to need this indicator to do this. And if it doesn't do that, then then that move over here isn't going to go far. It'll go right back down. Okay. Couple more charts here. Here is the NASDAQ below versus the NASDAQ bullish percent above. Obviously, we got a big range up here. Okay, kind of getting dangerously close to the bottom of the range. As you can see, I mean, this 52.5% has been an important number. You could see here way back in 2015 where the bullish percent trended down, while the market traded sideways, and so that internal deterioration led to the market falling pretty hard. Okay, then on this bounce, you can see here that the NASDAQ bullish percent failed to get above this 52.5% level, while the market traded here. You can see this range right here. Okay, and then so that because it failed to get up to a higher level, that too led to another dip here in the early 2016. But then the indicator got above 52.5 and it's been up there ever since. Okay, so if we continue to get deterioration here, okay, we got some lower highs, we got a higher low, but if we fall into the low 50s and we can't recover, then the market's probably not going to do very well. Okay, so if this indicator kind of comes down here while the market continues to trade sideways, you're probably going to get one of these air pockets here where it's going to break down and fall. Okay, so we're going to want the bullish percent to hold the bottom of this range here and move up. Okay, one more chart. This is a bullish percent at the NYSE. Okay, similar concept here. It's got to get up to a higher level and hold it in order to confirm any type of strength. So if you're a bull and you're looking for hints below the surface that strength is coming in, or there's strength brewing, or the market is just getting ready to, we just need to get the Fed out of the way or earnings season out of the way, it's not showing up in these charts. Okay, it's not there. Now, if the market does move up, fine, this thing could break out. But if it doesn't break out and really get up to a higher level, then no breakout's going to last very long. Okay, now let me go back one. Okay, these are pretty simple indicators. Okay, and there are not that many of them, but they're pretty much all you need. You don't need a huge checklist to determine what's going on in the market. In order for a bounce to turn into a full-blown rally, advancers need to outnumber decliners. Advancing volume needs to be greater than declining volume. New highs need to expand. The percentage of stocks above key moving averages need to move up. It's not that hard. Okay, it's not rocket science. It's not that far-fetched for me to say more stocks need to be above their 50-day moving average for a rally to sustain itself. Okay, right now the market is neutral. I'd rather have a trend, but it is what it is. Okay, here's the 50-day, not the 50-day. Here's the S&P daily. Okay, we have lower highs, we have a higher low, and now the index is right between its 50 and 200-day moving averages. Okay, pressure's building. We should get resolution soon, or we can get a total dud and a continuation of the range, throughout the summer. Okay, recognize the state of things and make needed adjustments. All right. Thanks for listening. Come check us out at Leavitt Brothers, leavittbrothers.com, leavittbrothers.net. We can help you navigate the market and make money.